Hey, my friend, welcome back to the State 48 Homeowner Podcast, where we help Arizona homeowners and future homeowners make smart, confident decisions about buying, selling, and caring for their homes. In a recent live stream for first-time homebuyers, we dug into some of the most common questions and myths that we hear all the time, like whether you really need 20% down to buy a home, how much credit you need, and what down payment assistance programs are actually available. On today's episode, we're bringing you those conversations with Unity Home Loans finance expert Steve Farrington and my business partner Twila Edwards from the Klaus Team, as we bust some myths, talk about some financing options, and share tips to get your credit mortgage ready. So let's talk credit scores and down payments today on State 48 Homeowner.
Hi, I'm Kenny Klaus, and this is State 48 Homeowner.
So Steve, one of the things that came up in advance was one of our clients had asked what the difference between a pre-qual and a pre-approval.
Great question.
Yeah. Pre-qualification is, the best way I can describe it is just an online process to where you just put in, it's usually maybe just 5 or 6 questions at most. Your estimated credit score, an idea of what your income is, how much money are you planning to put down. None of these things are truly verified. Once in a while, if you are able to put in a social security number, which I wouldn't do online unless you're talking to a professional, they'll do a soft check of your credit, which is typically only one bureau, not all 3 bureaus. So again, it's just a qualification based off of information you've input, based off of 5 or 6 questions, and then they kind of spit out a number based off that information. And as Twila mentioned, some of the calculators that are used, they don't know what county you're looking in. They don't know what type of property you're looking for. Pricing on a condo, meaning rate-wise, can be different than it is for a single-family residence versus a manufactured home. Are you going FHA or conventional? So again, those pre-approvals just kind of put together numbers based off of what you input, without anything verified. A pre-approval is having that conversation, collection of documentation, W-2s, pay stubs, bank statements, a conversation about, after we pull your credit, to take a look at it and maybe eliminate some debts, like, oh no, this is paid off, or no, this is a duplicate, or, all of the true verification of all the information and documentation. So again, you have a solid pre-approval. So that's the difference. Pre-qual is just, it's worth about as much, in my professional opinion, as the paper it's written on. I mean, the pre-approval is something that's a little more solid.
Verified. It's just whatever we told you.
It's whatever they told you, and that's fine, because sometimes it just gives us those quick answers that we're looking for. But to write an offer on it, I mean, you guys have a specific form for the Arizona Association of Realtors that's required to be filled out by the lender with boxes checked that we or I have reviewed those documents on there. So again, and that has to be submitted with every offer. Am I wrong on that, Twila?
Yeah, it's actually in the purchase contract. Yeah. It's funny because some agents are like, "Oh, I'll send it to you after we go under contract." I was like, no, that's part of the purchase contract. Again, experienced agent, know your contract.
So again, that's the difference between a pre-qualification and a pre-approval. Pre-approval, things are fully verified, a heck of a lot more confident when you're heading out there to make an offer on $300,000 or $400,000 transaction.
So Steve, let's talk down payment, because I know that I know it's a fact that you need 20% down. Is that correct?
No, that's a big myth.
Maybe 1970.
Well, and it's interesting to me because through studies and surveys that, we review every year, and this one, thanks for bringing that up, Scott. I mean, this one was most recent from NerdWallet, just conducted May of 2025. November 2024. Forgive me, I didn't put the new one up. Sorry, my bad. But this is November 2024, where look at the percentages of people that you believed you need 20% or more down payment. And that's by age group. So it's not just millennials or Gen Z or Gen X. You've got baby boomers who maybe have bought or sold multiple homes, but back when they bought their first maybe 1 or 2 homes, they had to put 20% down. there wasn't options or opportunities. Or maybe that's what they were told previous to. So again, you've got 55 to 65, 66% of all people polled in this survey from NerdWallet still believe you need 20% down. That's just not the case.
Well, let's
totally false.
Let's talk about the benefits.
What's that, Twila?
Totally false. Because even if you don't do down payment assistance, right? 3 is, I know, not the best conventional loan, but I know we have 3%, 3.5% for FHA or 5% for conventional. See?
No, and it never fails. Every year, I'll look at multiple surveys like that are done by NerdWallet, Bankrate.com, Wells Fargo. That's usually it's 2 out of every 3 buyers surveyed believe they need 20% more down. Yeah. So here are the standard programs that you need less than 20% for low or no down payment options, right? Of course, VA Home Loans offers 0 down option for eligible borrowers. And again, those would be those active military service, surviving spouses, or veterans of the military. Then FHA Home Loans, which Twila mentioned earlier, they offer a 3.5% down payment, and that down payment's always based off the purchase price of the property. FHA also has a little bit more relaxed qualifying guidelines, meaning for credit versus conventional options. And conventional really refers to, when you hear that term, Fannie Mae and Freddie Mac. And Fannie Mae and Freddie Mac offer as low as 3% down payment for qualified borrowers. A lot of times you have to be a first-time home buyer to qualify for these 3% down payment options, but you don't necessarily have to. There are options outside of that. One of the borrowers can be a first-time home buyer, or you haven't been on title to a property in the last 36 months. That requalifies you as a first-time home buyer. So maybe you owned a home 10 years ago, sold it, rented while you transitioned into your new state or new lifestyle, and now are ready to get back into home ownership. You can be reconsidered as a first-time home buyer once again. And then, of course, there's USDA home loans, which I would be remiss to not at least mention them. They offer 100% financing options for qualified buyers and properties. They got to have both. And the properties must be deemed rural by the USDA map. But again, these are all of your options to dispel that myth of I need 20% down or more to buy a house. You don't.
So let's talk about down payment assistance programs.
Awesome. Yeah. I mean, there are assistance options for down payment and or closing cost, and there are multiple options from multiple sources. That would be a whole nother live stream on its own. But there are, top of the board is kind of those FHA assist, grant, and bond programs that are out there. These programs offer, second liens, whether they're forgivable or repayable. And the down payment amount, I mean, that's where the categorization comes in, is like a true second lien. That type of assistance is amortized and set over a time period and an interest rate, which results in a discounted second mortgage payment, but meaning that you don't have to have the down payment. They just give you a true second for that assistance. There's the forgivable and silent second, which is what most people refer to, and a lot more common ones. It's an interest-free silent second with no repayment on it unless the home is sold, transferred, or refinanced before a set time period. And it really depends on the specific program, but usually those are 3, 5, or 7 years. And then there's grant programs. I mean, there are grant programs that come up all the time through some of our other lender partners through Klaus Team that, cities, states, local governments offer, funds to help homebuyers get into homes. That it's a grant. There's literally no strings attached to it in some cases, and up to some programs you've had, Twila, up to $50,000 for first-time home.
$50,000.
So there are multiple options, and again, working with the team, and again, I don't offer all these programs. I mean, I'll just be flat out honest with you. I don't, but at least I know them, having a partnership with the Klaus team that I can say, hey, this and this lender, or Twila just mentioned, or the office just mentioned that this grant program is becoming available again August 1st. Talk to Twila about it, because again, my whole goal is, get people into a home. I mean, the value of home ownership is just leaps and bounds over renting, in my opinion. So
That's how I feel about the down payment program. Sometimes people are like, well, they come with a little bit higher interest rate and things like that. But I'm like, but it also gets people in houses. I've helped people buy houses with down payment assistance that if they hadn't used that program, they still would not be in a house.
Right.
So
and
I feel like it's
ultimately
definitely
the goal.
Yeah.
So Steve, tell us about gift
It really
funds.
is. Yeah, I mean, and then there's gift funds. I mean, gift funds is another way to get into a home. It's kind of a down payment assistance, but it's coming from a friend, a family member, spouse, child, relative by blood, marriage, adoption, your fiance, domestic partner. In some cases, individuals with close family-like ties. I mean, I've done gifts that have come from employers. So again, gift funds is basically.
I just say what I've learned about gift funds from Steve and from other is just don't start moving money around. Tell them you're going to do it, but more than likely you're going to send that money right to title. But talk to them before you start doing any of that crazy stuff, right?
Yeah, Twila is exactly correct. I mean, the biggest thing with gift funds, and it's great the generosity that others will have. Mom and dad want to help their son or daughter get into their first home. They're like, oh, well, we're just going to move X amount of money into your checking account. And no, have that conversation with Twila and myself, and I'll tell you, I'm like, nope, just have your mom and dad leave the money right where it's at. And then when time comes, we'll have them move it right over to title and escrow company. Plus, hey, I have a daughter. I'm not giving her $30,000. I'm going to make sure it goes towards that house, right?
Right.
So Steve, tell us about this 1% down program.
So being a broker, lenders, once in a while, wholesale lenders will come up with their own proprietary products. A couple of our lenders right now have a 1% down payment program. It'll help buyers get into their home with as little as 1% down, meaning that the lender will cover 2% of that 3% down payment required by Fannie Mae and Freddie Mac. So again, it comes with qualification on those Fannie Mae and Freddie Mac programs, the conventional programs. And the buyers can use gift funds for that 1%. So maybe mom and dad don't have the full 3% to help you out with, but they can offer you a few $1,000s. So again, it's an ideal program for those that maybe have limited funds. And it's great 30-year fixed at market rate with discounted PMI because you're a first-time home buyer. So again, just everything we can to help those first-time home buyers leap that hurdle of affordability into home ownership.
And then this is an example of a zero down program that we have here. This is, for people that are first responders, teachers, military, medical workers, or people that work for a company that employs first responders, teachers, military, medical workers. This is
what I love about this program is, you guys know I used to be in education, and some of those programs are teacher specific. We have some down payments that are just for teachers. This one here is, like Scott was saying, anyone who works there. So anyone who works in the school can qualify for it. Anyone who works at the hospital, you don't have to be a doctor or a nurse. You can be the medical assistant or the front office girl that can still qualify for this. And it's a great program because it's 100% financing. So no down payment and no PMI, which is the mortgage insurance, which can be what, a couple $100 a month, right, Steve?
Mm-hmm. Correct.
And so we have people, I work closely with the police department. We have people that are working in the offices, professional staff like, people downtown, people in secretaries and stuff like that also qualify. So reach out with questions about those kinds of programs. Steve, this one came up. What is the average credit score needed to buy a home?
Oh, that's a loaded question, Scott. The average credit score, and again, I hate to be general about it, but it really depends on the program. You're going to find that, your FHA programs for the 620 is the minimum for an FHA home loan to get the best. You can go down to a 580. You can go down to a 500 FICO score, but you have to have more down payment and maybe the terms aren't as favorable. Most times 620 is really the minimum credit score you need. And then let us work what program is going to be best for you, because a lot of these programs are going to have, credit score requirements to get into them. Some down payment assistance programs require a 640 or a 660. Fannie Mae and Freddie Mac like to see the higher credit scores to give you a better interest rate, lower private mortgage insurance, and qualify for 3% down payment programs. If you have a lesser credit score and are trying to go conventional, they might require more down payment from you, or you're going to pay the expense of a higher monthly mortgage insurance premium and interest rate. That's where FHA really comes into effect. And as far as VA programs, there's no minimum FICO. They have their own criterion trying to help veterans and active military members get into homes. So again, loaded question, but a great question. But typically I tell people 620 plus, you're looking pretty good. Most things are available to you.
So let's talk about how we, how do we get there? How do we get to that score?
Oh man, well, and Twila will tell you this as well, is your credit score is crucial when applying for a home loan. And why it matters is, like I just mentioned, approval, the higher the score, the more likely you are to be approved, period. I mean, regardless of program, the higher your score, the more likelihood that you're going to get approved. Interest rates, the better the score. I mean, the higher the score, the lower the rate, and it can save you thousands. The credit scores also affect that PMI factor, and loan term and options. Some programs and even lenders have overlays to just general secondary marketing guidelines that some lenders require minimum credit scores above and beyond what Fannie Mae, Freddie Mac, or FHA, VA will require, because they just don't want to deal with the lesser credit scores. So again, the part of the slide that's most important is really looking at, people ask me quite often, what are the biggest factors that affect my credit score? And this wheel really breaks down by percentage. You can see that 35% of your credit score is your payment history, period. Mm-hmm. I tell clients, hey, the best things you can do is make your payments on time. Even if it's just the minimum payment, just make your payments on time. Credit utilization is another 30% of that. So 2/3 of your score is really, credit utilization is the limit on your credit card and the percentage of that limit that's being used. So again, if you have a $100 limit and you have a $90 balance, you have 90% utilization. Ideally, you want to keep it 25% or less to maximize your credit score. And then, of course, the others that make up the other 35% is your mix of credit, revolving versus installment, which is typically car loan, student loan versus credit card debt. 10% is new credit. So, sometimes people will rush out. They're like, oh, I want to buy a house this year and I need to improve my score. So I'm going to go out and I'm going to open 2 new credit cards because somebody on YouTube told me I need more credit to have a better score, rather than just having that one credit card that they've paid on time over the last 5 years. Because length of history makes up another 15%. So if you have a new credit card and it's only got a 6-month history on it, that's going to drag down your score in some cases as well. So it's a multitude of things, but the number one thing is make your payments on time. Payment history is number one.
Yeah.
I also look at this, and just from what I've learned over the years is when I'm talking to buyers and they're like, well, we're working on our credit. And I'm like, well, what are you doing? And if it's like, we have to pay down debt and these things, I'm like, have a conversation with Steve or a good lender. Don't just make those decisions because of something you saw on TikTok or YouTube or whatever, because sometimes if you pay off a credit card, it's not what you should have done, or there's different strategies to it. So I'm like, definitely talk to the professionals. If the goal is to buy a house, let's get them involved so that they can tell you the best thing to do, Yeah,
they'll close a credit card and they'll choose the one that they've had the longest, which is detrimental. And then they got the brand new credit card that they keep because it has a nice special program. They get rid of the the credit card that they've had the longest that doesn't have all the perks, but that's the one that is doing the best for their credit score.
Yeah. I had a client a few years ago that was working on that, and they were selling and buying, and their thing was they were going to pay off a credit card and do XYZ. And the lender was like, well, wait a minute. And this is probably terrible advice. So again, you talk to the lender first, because he looked in their one car loan, they only had like 4 payments left. And he said, well, if we pay off your car instead of wiping out the 2 credit cards, it gives you more buying power because the car payment's a lot higher than the credit card. So again, I'm always like, I am not the expert at that. That's not my side of the road. So I'm going to send you to the other side and let them work on that, because we want to do what's best for you to get you into a position of buying a house with the best credit score and the best terms for you. So,
right.
So here's some hints that Steve's got.
So, people do ask me, they're like, well, how do I improve my existing credit score, or even build positive credit, or even maintain my ideal credit score? And again, here's a few tips and tricks that I've gotten from credit repair companies that I've worked with over the years. Again, number one is make on-time payments. Time and timely payments is overall what's required. But if you don't have any credit at all and you want to start building it, these are some great tips. They say open at least 2 credit cards. You can set the limit, hey, just because Capital One offers you a $3,000, limit, say, no, you know what? I don't want more than $250, or whatever that limit, it's manageable for your budget. And open at least 2 credit cards and keep the utilization rate around 5 or 10%. Charge things you would normally pay cash for, a coffee at Starbucks, a tank of gas at Circle K, and pay it off. You can pay it off at the end of the week when you get your paycheck, or wait till your monthly bill comes and just pay it off immediately. Number 2, which I think is a great tip, is set up auto pay or reminders to ensure you have the funds and pay your accounts on time. It's really one of the things, a lot of times we don't want to have that access, but even if we set up reminders, because your credit card bill runs on a cycle and it's due the same time every month. If you look at your Citibank card and go online, you're going to see that your statement ends the 18th of every month. Set a reminder on the 15th, like, hey, Citibank Visa card's due in a few days, and just check your balance and see where you need to be. And, you can add self-report accounts, which I see a lot more frequently now. Experian started this, where you can add your rent, you can add your utilities, you can add your Cox, your Verizon to your credit report. These are the self-reporting accounts that you pay each month. Just remember, again, a good tip from a credit repair company is any late payments you make to your utilities are also going to show as well as you're on time. So be cautious. And if you already have a couple, small credit cards, you don't need to add more. You're going to be just fine. That's one of the tips.
Sounds like a good excuse, though.
What's that?
I said it sounds like a good excuse, though, right?
Well, sure.
That's kind of like the logic sometimes. People are like, oh, but I have 5 credit cards. And you're like, well, you don't need 5 credit cards.
You don't. No, you need one. This is what was taught to me many years ago, is for the algorithms to report properly for Experian, Equifax, and TransUnion, you need one active, usable, revolving trade line. And that's it. 2 is ideal, meaning that if you don't have an installment debt, like a car payment that you make payments on each time, that's why number 1 is have open at least 2 small credit cards and keep the utilization rate low, because that revolving credit card really kind of builds your score faster. The other thing that we can do is be added as an authorized user to maybe your spouse or partner or a close family member. And a lot of parents do this, to where they can add, a younger adult in their family, their son or daughter that just turned 18, to help them build their credit scores, is add them as an authorized user to a card that you have, again, good history on, make your payments on time, because obviously I don't want my daughter Twila to inherit my bad credit history, right? But just ideally you can add them. You don't have to give them a card, but you can add them as an authorized user. And then number 6, I think is key, is monitor your credit and keep an eye out for errors. You can go to freecreditreport.com, get an annual credit report once a year, a free full tri-merge, and see what's on your credit report. see why your scores are low. Or again, start the process early to where, I can take a look at your credit, tell you what your scores truly are versus just those monitoring services, and maybe what we can do to build your credit and maintain your score as you head into that path of home ownership.
We hope you picked up some helpful insights about down payments, credit scores, and the real options that are out there for buyers today. The big takeaway: don't let the myths hold you back. You don't always need 20% down. There are assistance programs available, and improving your credit is possible with the right guidance. More importantly, markets change quickly, which is why strategy, teamwork, and partnering with experienced agents and lenders makes all the difference. If you found this episode helpful, go ahead and like this video, subscribe, and hit that bell so you don't miss future episodes with more practical tips for Arizona homeowners. Thanks for watching, and we'll see you next time on State 48 Homeowner.
Thanks for spending time with us this week at State 48 Homeowner, the ins and outs of owning an Arizona home. You can connect with us for more information, submit topics you'd like us to further discuss. You can see relevant videos, give us feedback, answer your real estate questions, and more at state48homeowner.com.